I'm a chartered financial planner here at Equilibrium Asset Management. So the first thing that you need to differentiate between is savings and investments. Savings is money that you've allocated for short-term, so short-term day-to-day living expenses. Maybe you've got a purchase in mind, like a car or a holiday, and the last thing you want is that when you come to make that purchase, that the money's not there. So you always want to keep your short-term savings in cash. Investments, on the other hand, are made with a long-term goal in mind, and that might be saving for a house deposit that's a few years away, saving for retirement, or even just allocating surplus income that you're not using day to day. Because you've got a long-term goal, you've got time on your side, and the earlier you invest, the more time you have. Because you've got a longer time frame, it doesn't really matter if the investment falls in value in the short term, because you've got a longer period for it to recover. And even if it fails completely, well, you've got 30 to 40 years in which you can earn more money to replace it. So start by looking at what you're bringing in each month, and more importantly, what you're spending. So once you know what you're spending, you can look to carve out part of your income for savings and investments. So sit down, look at your bank statements, and see what works for you. Remember, there's always going to be things that you can spend your money on. So be sure to think in terms of what you want and also what you actually need. Secondly, be your own external force. Think of all the direct debits that you have coming from your account each month. Do you actually notice them all? Once you know how much you can afford to invest each month, try to automate it so that your investment becomes a habit and you avoid temptation to spend it. Do some research. There's a vast amount of information out there, so you don't need to go overboard, but begin to get an understanding of what it is you're investing in. Don't panic. All investment comes with a degree of risk, and values will rise and fall over time. Lastly, investments are often misunderstood as a way of getting rich quick. This is wrong. Investing is about trying to make your money work harder for you over the long term. There's always going to be people who talk about their big wins, whether it's on an internet message board or in the pub or at the gym. But think, is that same person really going to be as forthcoming in talking about their big losses? So as I said before, all investment comes with risk, but there are ways that you can manage the level of risk that you're exposed to. Two common concepts in investments are diversification and pound cost averaging. Diversification is often best summed by the phrase, don't put all your eggs in one basket. Think about investing in a single company share. If that company's share suffers a big downfall, your investment's going to suffer the full brunt of that. But if you split your investment across different shares in different companies, you can reduce that potential risk to your investment. The second concept is pound cost averaging, and this addresses one of the biggest dilemmas faced by all investors: timing. Even for professional investors, it is impossible to time the markets perfectly. The idea behind pound cost averaging is to make small investments on a regular basis. By drip feeding money into investments, it means that you buy more of it as you fall and less of it as they rise. So the price that you pay is averaged out over time, and this strips out some of the volatility that you face day to day in markets. So before you make any investment, put in place an investment strategy that works best for you, and then have the discipline to stick to it.